So in this question, we are going to discuss about the dividend growth model and the earnings yield method. So this question was asked in June 2015. So we'll start from the required. So there are three required here, and the C is refers to a theory question. So we will be like doing A and B. Calculate the equity market value of CCO using the dividend growth model. Calculate the equity market value of CCO using the earnings yield method. So we'll start. CCO is a stock market listed company which has managed to increase earnings over the last year. As a result, the board of directors has increased the dividend payout ratio from 40% for the year to March 2014 to 41.4% for the year to March 2015. CECO has a cost of equity of 12.5%. The following information is also available. So we have the 2014 data and 15 data, and the numbers given are in thousands. So we have earnings, we have ordinary shares, and then he tells the nominal value of the ordinary shares of CECO is 0.5 per share. Listed companies similar to CECO have an earnings yield of 8.2%. So to do this problem, I have already created a format. So for A, this is the format. We have to value the equity using the dividend growth model. So this is the formula. P0 equals to D0 into 1 plus G divided by KE minus G. So they're asking to value the entire company. So we can take the D0 as the total dividends. So it works like this. So the D0, we'll take it as total dividends, and whether this total dividends is available, the answer is yes. We have no, we do not have the dividends for 2015. We have the earnings. Okay, so we have to find out the dividend for 2015. So we'll find it out. So the earnings of the company in 2015 is 13,840, and this number has to be multiplied by the dividend payout ratio. The dividend payout ratio is 41.4%. So let's see, we get an answer. So we got the number. So this is the amount in terms of thousands, and we have to, so we have got our D0 here, but we do not know our G. So G is growth in dividend. So growth in dividend is the dividend growth from 2014 to 15. So this is the dividend for 2015. We have to do the same for 2014, and we have to find out the total dividends in 2014. So the number again would be 13,200 into 40%. So that will give us the answer. So now we can find out the growth rate. So growth rate will be the latest number minus the previous year number. The difference is the increase in dividend. So that divided by the last year dividend, okay, will give us the dividend growth. So the dividend growth is 0.08, or if you want, we can multiply it by 100. We'll get our growth rate in percentage. So it comes to 8.51. okay, so that's the number we have. It's in percentage. So we can use these numbers to calculate our P0. So our P0 will be, so apart from, so we need to have the KE here. So KE we have to find. So KE is 12.5. So it is 12.5, or if you want, we can also take it as 0.125. So that would be like easy. So we'll find out the P0. So the P0 would be the D0, which is 5729.76 into into the G. So the G is 1.085. This divided by the KE minus T. The KE is 0.125 minus 0.85, 0.0851, 0.851. So we have got the numbers. So we have to put these numbers in bracket. So now we'll get the answer. So the answer that we got would come in thousands. Okay, so this is a number that would have been like expressed in terms of thousands. So if you want, you can mark it. So this answer is in terms of thousands. Okay, so that's about this answer. So we'll move on to the next method. So the next method is the equity value using the earnings yield method. So the earnings yield method works like this. The P0 equals to total earnings divided by the earnings yield. So if you are going to use total earnings in the numerator, you will get the entire company's value. This formula can also be expressed like this. So P0 equals to EPS divided by earnings yield will also give you the number, but this answer will give you the per share value. Okay, so we don't want per share value, we want the total value. So we'll work out like this. So the P0 number is equal to the formula. So first we have to get the total earnings. The total earnings is 13,840 divided by the earnings yield. So the earnings yield is 8.2%. So we'll put as 0.082. So that will give us our answer. So our answer has come, and our answer is in terms of $1,000. Okay, so the answer comes to 1,68,780. So that's about this problem. We'll move on to the next one. So we'll start with this problem. So this problem is a valuation problem, and this question was asked in June 2013, and we'll start with the required. So it is a lengthy question. So using the dividend valuation model, calculate the value of GCO under option 1 and advise whether option 1 will be acceptable to shareholders. So we'll solve this. They're asking to value us through dividend valuation model. So we'll just go through the entire question. GCO is a e-business which designs and sells computer applications for mobile phones. The company needs to raise 3.2 million for research and development and is considering three financing options. So option 1 is GCO could suspend dividends for 2 years and then pay dividends of 0.25 cents per share from the end of the third year, increasing dividends annually by 4% in subsequent years. Dividends in recent years have grown by 3%. So this is the option, whether the suspension of dividends for 2 years and then paying 25 cents of dividend from the third year end, increasing annually thereby of 4% is accepted, or will investors choose to stick with the current policy of getting the dividends at 3% per year? Which option they will choose is the question. So the question is not about option 1 versus 2 versus 3. Within option 1 itself we have two sub options, so that is what we have to work out. So to work this out, we have to read other information. So 2 and 3 we leave. We also have some information regarding these are common information. Okay, these are common information. So recent financial information relating to GCO is as follows. We have operating profit, interest, PBT, taxation, profit after taxation, dividends we have, ordinary shares, and the normal value is 50 cents is there. So under option 2 and 3, they have given some data. We'll leave that. The profit tax rate paid by the company is 20% per year, and GCO has a cost of equity, that is KE, which is 9% and which is expected to be constant. So these are the information. So I have already created a format for doing this sum. So what we'll do is we'll work out as per this format. So we'll start from requirement A, which is the dividend valuation model. There are two methods, which is the current method and the proposed method of dividend. The current method, we'll find out the current DPS first. So to find out DPS, this is the formula. So we need a dividend divided by number of shares. So first we need to find out the dividend. Okay, so the dividend will be 1600 in terms of thousands. So we'll start. So it is 1600 multiplied by, it's referred in thousands, so we'll take that number also. Okay, so the number of share is 5000 in amount, and it is expressed in the amount of 1000. So each share is worth 0.5. So this will give us the number of shares. So we'll work out. So this is our total dividend, and this is our number of shares. So our dividend per share will be dividend divided by number of shares will give us our dividend. So 0.16 is our dividend. So how this dividend grows? So we'll have the formula. So the formula is like this. So the formula is this. So we'll value it, and we have to get certain percentages. We have to get a G number and KE number. So G number, he has already told us that it is, these dividends in recent years have grown at 3%. So we can have it as 0.03, and KE was mentioned in the last, which is 9%. We'll have KE as 0.09. So we have both the numbers. Now we can easily find out the method. So our formula is like this. D0, which is the dividend per share, we'll have that. We'll have 0.16 into 1 plus G, 1 plus G divided by KE 0.09 minus G, close the bracket, get the answer. So we'll get it here. So the answer comes to 2.74. So this is an important answer. So our P0 is this number. So if you want, we'll mark it here. So this is our P0. Okay, so this is an important number. So under a current method of dividend payment, okay, this would be the value of per share. So this is a per share value. So now we'll find out how this works in terms of the other option. That is, the company could suspend the dividends for 2 years and then pay a dividend of 0.25 per share from the end of the third year. Okay, increasing dividends annually by 4% in the subsequent years. Okay, so we'll start from this. The number that which they have given is D3 number. So what we have to do is we have to do D3 divided by KE minus G. If you do this, you will get the D2 number. Then if you're going to like use discounted value, then you can multiply and you'll get the D0 value. So we'll work it out like this. So if you take the discount factor at 9%, the value for this will be 1 divided by 1.09. That will be this number. So this number would be this number would be the previous number, which is 0.917, that divided by 1.09. So this is the discount factor. So when we do D3 KE minus G, we'll do it here. So we'll do D3. D3 is 0.25 divided by KE, which is 0.09, and G, in this sum it is 0.04. So close the bracket, and now you will get an answer. So the answer is 5. So we are going to perpetually receive $5. Okay, that is what it is mentioning. So the D3 divided by KE minus G gives 5. Okay, once you have done KE minus G, then this 5 will actually become D2. So multiply these, you will get the P0 value. So P0 would be this 5 into this number will be the dividend method. So 4.2. As the 4.2 is higher than the 2.74 of value, it is better to go for the proposed method. Okay, so that is what we have to tell. So suggestion would be shareholders will accept the proposed method as it is more rewarding. Okay, so that's what they would do, and that's about this problem. So ensure that you understand this method. Okay, and we are good to go. We'll move on to the next problem. So the next question is, calculate the effect on earnings per share of the proposal to raise finance by a stock market listing, option 2, and comment on the acceptability of the proposal to equity shareholders. So we have to find out the EPS. So they are going to raise finance, and raising finance, we have to find out whether the EPS will be like how it is affected. To know how it is affected, we have to do two things. One, we have to find out the current EPS, and we have to also find out the EPS after the proposal. So this is the EPS formula, the total profit after tax divided by the number of shares. So to work out current EPS, we have to have these numbers. So we first need total PAT, or profit after tax. So that number is directly given here. So we'll take it. So it is 2600 into the 1000. That's a value. The total number of shares, I think we have already calculated that. We have calculated it here. So we can take that number and we can use it, and we will work out this also. Okay, so our EPS would be PAT divided by number of shares. So this is our EPS. So what we'll do now is we'll find out what is a proposal. So to know the proposal, we have to do the option 2. GCO could seek a stock market listing, raising 3.2 million after issue cost of 1 lakh by issuing new shares to new shareholders at a price of 2.5. We have to find out how much of amount the company is going to raise. The company is going to raise 3.2 million plus the issue cost also, and each share is going to be 2.5 worth. Okay, and we'll check any other information is given. We've left this information earlier. Under option 2 and 3, the funds invested would earn a before tax return of 18%. So the money of 3.2 which is invested in the company will generate 18% of return. So that is what is given. So we'll start. So we'll start with the EPS. So we'll find out the total PAT and the total shares. So for finding out the total profit after tax, first we'll start from the existing PAT. So our existing profit after tax is this number. Additional profit, we'll calculate it here. So the company is going to raise how much? It's going to raise 3.2 million. So we'll multiply. So it is 3.2 million. and this number is going to be invested and the company will earn 18%, but they have to pay tax for this because it is given as before tax. So tax has to be considered here because the number which we are trying to find is the profit after tax. So we'll have it as 1 minus. So tax is 20%. Profit paid by the company. Profit tax paid by the company is 20%. So we'll take it as 0.2. We'll close the bracket and we'll get the answer. So we'll take this, we'll put it here. We put an equal. We got the number. So both these numbers, this as well as this, will give us our total profit after tax. Existing shares we know. So this is the number, total number of shares which is existing. We'll take that. And new shares in issue that we have to find. So the company is raising this much of money. So we'll take it quickly here. So the company is going to raise this much of funds. Okay. Additionally, they are going to also incur 1 lakh. That 1 lakh is also to be recovered from the issue of shares. So again, we have to take that. And this number divided by the value of per share. The value of per share that they are trying to get is 2.5. So we'll divide it by 2.5. So this will give us our answer. So we'll add both. So we got an answer, and this is the total shares. So we'll find out the PAT. So the PAT will be this number divided by the total shares, and our PAT, sorry, our EPS after the proposal comes to 0.27. So that means suggestion will be as the proposal increases the EPS, the shareholders will accept the proposal. Okay, so that's about the choice here. So they will accept the proposal because when compared to the existing EPS, the EPS after the proposal seems to be a higher number, so they will accept it. So that's about the requirement B. So we'll move on to the requirement C. So we'll start from requirement C. So requirement C is here. Calculate the effect on EPS and interest coverage ratio of the proposal to raise finance by issuing new debt. Okay, and comment on your findings. So we'll start. So option 3 is GX Co could use 3.2 million of bonds paying annual interest of 6%, which is redeemable after 10 years at par. Okay, so rather than going for equity issue, they are going for debt issue. So we'll start. So for doing this, we have already done the current EPS. Okay, that comes to 0.26. But what we want is the EPS after this proposal. So we'll start from the existing PAT. So existing PAT we already have, that we'll take. What is the additional profit that we'll make here? So the additional profit will be the same this number. Okay, so we'll make this as our profit, but there is an interest cost. Okay, so interest cost we have to consider. So interest cost we'll do it. Interest cost would be 3.2 million. We'll take the same number, 3.2 million into, we will pay an interest of 6%, and this is the benefit that we get, the tax benefit. So we can work out this number and we'll get an answer. Okay, but this, if you check, it is a cost, so we'll have it as a minus. So now we'll copy it. So the total PAT will be like this. We'll take the sum of these numbers, close the bracket, and we'll have it. So this is the PAT. So the existing PAT, the additional profit made by the company after tax, and the interest cost, which is after tax. So finally we got our PAT. So we have to find out our existing share. Our existing share will not change at all, because our existing share will be the same, because we have issued only a debt issue. So our total share will be the same as this, so that won't be a problem. But what would be our EPS? Our EPS will be our PAT divided by the shares, and we'll get the answer. It comes to 0.29. So when compared to the earlier, okay, existing EPS, which is 0.26, this is much better. But still we have to find out one more element, which is interest coverage ratio. So interest coverage ratio is PBIT, profit before interest and tax, divided by interest. So we have to work out the current interest coverage ratio and the revised interest coverage ratio. So we have to do both. So first we have to find out these numbers. So we'll start. So the existing PBIT is this number. Earnings before interest and tax is 3450 into 2000, and the additional PBIT, okay, that would be generated, profit before interest and tax, that we have to calculate. So that we can calculate it from here. So the additional PBIT that would be generated will be its profit before interest and tax. So we can take this number off. So this will give us our answer. So we can work it out. So our existing, so that's about our existing PBIT. So this is about our additional PBIT. So this will be our revised PBIT. So we also have to calculate the interest. So we have to calculate the existing interest. The existing interest is like very simple. It is 200 into 1000. So that number is here. 200 is already here. Additional interest, we have to find out what is it. So we already have worked out in the above. So we'll take that number and we can quickly do it. So the additional interest would be without tax. We should not take the tax element, and we don't need to have it as a minus number. So we can quickly work it out. So we'll take both these numbers and we'll paste. So this is our existing interest. So this is our new interest, okay, the additional interest. So both we have to just add and get the number. So that comes to 3,92,000. So that's about the total interest here. Okay, so we got our PBIT and we got our total interest. So we'll start with the current interest coverage ratio. So the current or existing interest coverage ratio works like this. Our PBIT, which is 3450. If you want, you can have the thousands, or you can also just cut it off. So I think we can have the 3 zeros also. So 123 divided by the interest. So the interest is 200. So it is 200, then 1000, 123. So this will give you our answer. If you take the interest, revise the interest coverage, it's going to be 4026,000 divided by 3,92,000. So we'll solve both. Okay, So the revised interest coverage is like falling. Falling is a bad signal. So we can put a suggestion like this. This option increases the EPS but decreases the interest coverage ratio. Hence, some investors will not accept this option. So we have come to our final element. So even though the proposal increases the EPS, it decreases the interest coverage ratio. Okay, from 17 to 10, it decreases. So that is a very bad kind of a sign. So they might not accept it. Okay, we just have to comment on our findings. So that's about this problem. So ensure that you understand this kind of a problem, because they can be also asked in a 2-mark questions also. So this element alone can be asked in a 2-mark, or this part alone can be asked in a 2-mark. So the same 10-mark problems or a 5-mark problems can be split and can also be asked as a 2-mark problems. So that's about this problem. We'll move on to the next one. So we'll start from this question. This is a TERP question, which is refers to theoretical X rights price and the effect on the EPS. So that's about what we are going to work out. So this question has been asked in June 2014. This question has several requirements, but we are only going to do the TERP. So we'll start from the required. Analyze and discuss the extent to which MFZ Co has achieved each of its objective. The second one is calculate the total equity market value of MCO for 2014 using the dividend growth model, and briefly discuss why the dividend growth model value may differ from the current equity market value. So we have already done this kind of a problem. So the C is calculate the TERP price per share for the proposed right issue, and the last one is a theory question. So we'll work out the requirement C. Okay. So requirement C, they have given us a lot of information. They have given year 14, 13, 12 data. They have given PBIT, PAT, dividends, equity market value, and they have also given us a lengthy paragraph. So they say that MCO has 12 million ordinary shares in issue and has not issued any shares in the period under review. The company is financed entirely by equity and is considering investing 9.2 million of new finance in order to expand the existing business operations. This new finance could be either long-term debt or new equity via right issue. The right issue price would be at a 20% discount to the current share price. So the issue cost of 2 lakh would have to be met from the cash raised, whether the new finance was equity or debt. So whichever we have to go, we have to pay this 2 lakh of amount. Okay, so this information is enough for us to calculate the TERP. So I have already created a format here, so we'll use this format. So TERP refers to theoretical X rights price. Okay, so it refers to after issuing the rights issue, what would be the price of the share. So the formula works like this: TERP equals to existing value of the shares, the market cap, plus the rights issue value divided by existing number of shares plus rights issue shares. So we'll put the TERP calculation here, but all these 4 variables we will find out individually here. We'll find out them in terms of millions, and to find out this we might have some working notes, so that we'll do it here. So we'll start from our each and every number. First we'll try to find out the existing market cap of equity shares. So that comes to 56.4. So that we'll take. So the next number that we want is the existing number of shares. So that also they have given. It is given as 12 million shares. So that we can directly take. So now we need to have a rights issue value. So totally how much of rights issue value of amount do we have to raise? So that we have to work it out. Company is considering investing 9.2 million. Okay, so that amount has to be raised. But if we raise 9.2, then we have to pay an issue cost of 2 lakhs. So this 2 lakhs have to be raised with this 9.2 itself. So what happens is the company has to raise 9.2 million plus they have to raise 2 lakhs also. So this 2 lakhs we have to convert it in millions. That gives us our million. So we have to raise 9.4 million of worth of amount. So how many shares should we issue for this? So the number of shares would be like this: 9.4 divided by, okay, this is divided by the share price. So share price is not given here. So the right share price is not given here. So that we have to find. So we have to put a question mark here. So we can't get a So we can't get the answer now. So what we'll do is we'll find out the existing per share value. The existing per share value is, again, that number is not given. So we have to find it out. So we'll take it like this. So it is 56.4 divided by 12 million shares. So that will give us the per share value. Okay. So 4.7 is the per share value. So out of this 4.7, there is going to be a discount in the rights issue. The rights issue discount is 20%. So we can mark it like this: 1 minus 0.2. So we'll work it out here. So the value comes to 3.76. So this 3.76, okay, we have to work out like this. This 9.4 is the million of amount that we have to raise, and the 3.76 is the value per share. So this will give us the number of shares, rights shares, that has to be issued. So this number is in million. Okay, so the total number of rights shares to be issued will be 2.5 million shares. So now we have got all the numbers. We just have to find out the TERP. So we'll work out a TERP here. So it's going to be 56.4 plus the rights issue value. The rights issue value is 9.4 divided by the existing number of shares, which is 12 million. So again, plus the additional issue of shares, which is 2.5. So you can add this together. Okay, so we can solve this and we'll get the TERP. So our TERP comes to 4.53. So if you take the existing share price is 4.7, and after the issue of the rights share, the share price will usually fall down, and that would come to 4.53. So that's about the TERP. So this kind of sums can come in for 2 mark also. So ensure that you understand how these works.